Hi, I'm Phil Grandy of philsgang.com, YouTube channel, well, my YouTube channel, and my radio show, philsgang.com radio show. Now, here we are, November 11th. We just finished the election, and then we had this report come out about inflation. And so yesterday, the big deal is, hey, wow, if I paid for a package of hot dogs a year ago, and now I pay for a package of hot dogs, they're 2 cents. I have a 2-cent savings. And people went ballistic. 2-cent savings on some hot dogs. What are you, nuts? This is insane. So consumer prices over the past 12 months came in at 7.7. Now that's, of course, lower than the 8.2% we're at now, but it doesn't justify a 1,200-point rally. That was a short covering rally. And by the way, during my program here, please do me a favor, hit subscribe, like, and share. I'd really appreciate it. So think about that. So people went nuts. What happened is the big institutions covered all their short positions, especially on tech stocks. Because here's why. Let me show you something. Look at this chart right here. This is the bond market right here. This is the 20-year bond market, okay? And when the bonds are going down like this, your yields will go up, straight up. Okay, that's why our yields been going straight up, because the bond market's been a lot of downward pressure on it. And yields go up, and then you have the stock market go down. Well, yesterday what they did by telling us that, wow, that's it, 7.7% compared to 8.2%, hot dogs are down 2 cents. Wow, we're going to stop selling our bonds here. Look what happened to the bond market. The bond market went up. So when the bond market goes up, what happens? Well, then you get the yields, instead of going up, the yields start coming what? Down. That's right, yields are coming down. And then when yields go down, the stock market goes where? The stock market goes up. Why? Because when yields start going down, that means the Fed fund rates start coming down. That's the rate at which the Federal Reserve sells money to your bank at 3.5%. Then your bank marks it up to you. So everybody got all excited because the yields came down yesterday. We came down from a high of 409 basis points to 382. But let's put this in perspective. Come on. This is ridiculous. So this was a big short covering rally. The big institutions, the big hedge funds, what they did, they covered their short positions on their tech stocks, because tech stocks, they hate high yields. And when yields came down yesterday, boom, everybody covered their short positions. When I say everybody, I'm talking about the big boys. So if you remember in July or August, we had the same situation. Remember, they said zero rates then. And remember, Biden went nuts right here. See it? Right in here. Zero rates. We had that big rally. Or look at it right here, that big rally. Zero interest rates. Remember, zero interest rates. He came on. Look at that. I'm doing a good job. Zero interest rates. What happened? Gave it all back. Now, here we are over here. Look, same thing. Same thing. Okay? Now, what they're saying is, well, it's different this time because after the elections, you always get a market rally, a feel-good market rally. You get and you do, that's true, okay? But here's the problem. This isn't like most times. We have a 24-year inflation. 24-year high inflation rate. Are you kidding me? We got stocks that are so overvalued, they're insane, because remember what QE does. QE, when they print money, the Federal Reserve, and give it to CEOs to buy their own shares back, it takes their earnings per share and move them up artificially. Look, you got to have profits to move your earnings per share up. That moves your stock price up. But QE, they've been able to move their earnings per share up without profits. And stock prices kept going up and up and up. We call that unearned increment. The stocks were going up for no reason other than the CEOs were cheating and buying their own shares, and by doing that, earnings kept going up, and the stock price keeps going up and up. And remember what we were told when they started with QE, they're only going to do it for about a year. No, we went 13 years. We have this tremendous inflation. We have stocks that are still way overvalued. The big institutions aren't going to start coming in and buying these stocks at these valuations. Powell is not going to stop raising rates. He's going to move that Fed rate from 3.5 basis points up to 5%. You wait and see. So this is all a bunch of good feeling nonsense. Now, if I'm wrong, it's okay, because we always follow the charts. Because with my charts, it always tells us when to buy, when to sell. Because we have a color-coded chart that we design. It's never wrong. Well, that's it. So yesterday, all these guys were on CNBC and Fox Business. They're all a bunch of bull-sitters. I said, sitters, S-I-T-T-E-R-S, bull-sitters. And they just do this all the time. They're always dealing in hope. We got facts. The facts is we are in deep trouble. We have tremendous debt. We have tremendous trade deficits. Inflation that we built over 13 years doesn't come down in one day because hot dogs came down, for God's sakes, 2 cents in a year. This is just crazy. So that's it. So, I mean, we may get a little bit more of a rally today, and it'll give it all back probably by next week. It can't sustain itself. If it does, okay, then we're prepared to go along with it, and we'll just keep buying stocks. That's all. That's the beautiful thing about knowing how to short and go long. Do you know that 80% of people lose money in the stock market because they don't know how to sell short? And by the way, let me show you something. We designed this chart right here so it makes it so easy for you to short. It turns red, and then you line up right here, and it tells you to sell short. As long as it stays red, you stay short. When it turns green, you buy. Check it out. Join my gang for 10 days free. You'll see it works. Okay, so that's it. I will see you on the charts.